Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Michael, thanks so much for joining us today.
It's always a pleasure to be on with you, Adam. And I know you're too humble to say this yourself, but your channel has become the place for financial news and information. And it's because of you. It's a privilege to be on with you. So thank you.
Thank you so much. And I appreciate the compliment, but I also appreciate you being a part of this whole experience as well. Let's start with the question. What is your current assessment of the global economy and financial markets?
Into that recession, we have the fastest rate of change. So interest rates on the overnight interbank lending rate are going from 0% in March of this year. We were still at zero, all the way to 5% in March. And quantitative tightening has just ramped up. It started in September. We're just now cutting about 90 to 95 billion a month off of the balance sheet. That's the environment we are in now. And yet we still have the equity market, higher price to sales ratio, a higher total market cap to GDP ratio than any other time prior to 2020. That's how expensive stocks still are. So that's your environment. And that's why I'm still bearish. Yes, I am very bearish. I think we have a 30% drop from here, unless and until we have a genuine Powell pivot, which takes interest rates back to zero, which goes back into QE, and or we get CPI below 4%. You're not going to get either of those things probably until Q2 2023.
You just said that you expect CPI to come down to the 4%-ish range over the next couple of quarters. That is classic disinflation. Do we even tip into deflation at some point?
In order to attenuate and truncate this recession, you're going to need some massive fiscal and monetary support. You're not going to get any monetary support. You're not going to get any TARP program. You're not going to get any helicopter money passed. So you're going to have no help. You're only going to have the automatic stabilizers that kick in during any recession. That's not going to be enough to turn this thing around very quickly. You're going to need, as I said, massive fiscal and monetary support. It's just not coming.
And you just mentioned yourself, you think that there's a big recession ahead, as well as maybe perhaps a 30% more decline in the markets. I guess my question is do you fall clearly on either side of that debate?
So we're going to have disinflation and deflation going forward, not inflation, because again, it's not a genie. It has to come from an impulse, and the fiscal and monetary impulses are not there any longer.
Okay. Is there potential for something systemic to break badly enough that it actually forces a policy pivot here that's material in changing your outlook?
Yes, there will be a genuine pivot, but the pivot's going to come too late to save stocks. That's when the pivot comes, I'll start covering my shorts, but not until then. That you can't, if the mindset is, well, Powell's going to pivot, and that's the mindset from most of Wall Street, well, Powell's going to have to pivot. Oh, yeah, I think he will, but he's going to be forced to pivot because the credit markets freeze. And the action of that happening is going to be very, very detrimental to all asset prices. That's the time you want to have already been short and covering your shorts, not thinking about getting short then if you have the ability to do so.
Got it. And I have had a couple other guests on this program that have echoed what I hear you saying here, which is, there's a lot of people that are thinking, pivot means everything's green again and back off to the races. Some of these experts have said, no, the thing that actually may force the Fed to pivot may be so bad that everything is getting crushed in some vortex at that time. So you're going to want to wait for the dust to settle from that. You don't want to be positioned in front of that because you'll get drawn down with it.
Exactly. And you had a gentleman on your program, a former Fed official, said, I'm not worried about a recession. I'm not worried about a stock market decline because there's, automatic stabilizers and these standing facilities in place.
Right.
Facility. But think about how healthy is the market, especially the credit market's going to function, the money market's going to function when banks can't lend money to each other. They have to get their money from the Fed at a penalty rate. Yeah, I mean, that's an attenuating process, but it's not going to bode well for stocks if everybody knows that the credit markets are frozen and they're relying on the Fed to reliquify the system. That's bad news in the short term for equities.
Some people doubt that Powell can even get to 5 or 5.25, which is sort of where he's guiding right now, right? They just think that something's going to break before then. I'm asking you just to kind of guess here. Do you think he can get there, or do you think the wheels start coming off sooner than that? Because, we have a much more indebted economy today than we did even just prior to the 2008 crisis. I think we have like 3.5 times more national debt, like 9 trillion versus 31 trillion now.
And I'm here every day working, so I'm going to make a prognostication that the Fed can get to around 4 3/4. But things are breaking now. I don't think he can get to 5. And when he gets to 5, and again, I'm not contradicting myself, but when he gets to 5 and he says, I'm going to stay there, if he gets to 5 and he says, I'm going to stay there for a long time, I think, and I already put the meat on the bones, I think the credit markets start freezing. I think you can't issue any more junk bonds. I think you can't issue commercial paper. I think the shadow banking system breaks, and that causes him to say, oh, I can't stay at 5 forever or months or quarters on end. I have to start cutting rates and heading back to 0.
Okay. And we are making our way to the how to allocate for all of this. But it sounds like, Michael, if I'm following you correctly, you think that Powell is going to try to do what he said he's going to do, hike to 5 and then hold for a long time. But it sounds like you're skeptical that he's going to be able to. Sounds like you think that something's going to break and he is going to have to change policy.
Correct. Credit markets, money markets freeze, and he has to change policy sooner than he thinks. I know he's like Nostradamus when it comes to markets and the economy, but he's going to be wrong again.
If something breaks, do you expect Powell to address it primarily by lowering rates versus QE, or do you expect, forget it, it's just back to the old playbook?
Well, the Fed doesn't just lower interest rates by decree, by fiat, the way they print money. They lower interest rates by printing money, which is a form of QE. QE just means when you get to 0, the zero bound, you don't stop there. You keep on expanding your balance sheet. But in order to get interest rates from 5% back towards 0%, the Fed has to print an awful lot of money and buy bonds and expand their balance sheet. So there really is just semantics here. If you're asking, will they go to 0 and stop? I'm hoping that's the case. I don't see any evidence of that because Powell said it himself. We know exactly how to get inflation going. So the action is the action. To lower interest rates, you have to go in there, create Fed credit, buy bonds in the overnight interbank lending market, and flood the system with money and bring down the cost of borrowing between banks. That's how it works. So it's a distinction with not much of a difference.
I guess first question is how concerned are you about the to be felt impacts of the rate hikes that have already been made in this story?
So I'm very concerned. Rate hikes come with about a 6 to 9 month lag, as you indicated. In March, we were still at 0. So September is when we first started feeling the rate hike pinch. And that was the same month we just started to ramp up quantitative tightening. So yeah, we're just in the outer bands of this hurricane. It's a Cat 5. So we have a long way to go.